There is a feeling you have probably never put into words, but you have felt it more times than you can count. It arrives on a Tuesday afternoon when you check your balance and the number is technically fine. It is not zero, it is not overdrawn, but something in your chest tightens anyway. Or it arrives at the end of the month when you realize you earned more this year than you did 2 years ago and somehow saved less. Or it arrives in a quiet moment when you look at your life from the outside, the job, the apartment, the subscriptions, the phone, the routine, and you notice that everything is in place, everything is running, and yet nothing is actually moving forward. That feeling does not have a clean name. People call it financial stress, but it is not quite stress because stress implies a crisis, and there is no crisis here. People call it anxiety, but it is not quite that either, because anxiety implies fear of something specific, and you cannot name exactly what you are afraid of. What it actually is a kind of suspension. You are not drowning, you are not sinking, but you are also not swimming anywhere in particular. You are just floating. And here's what nobody tells you directly. That suspension, that comfortable, manageable, slightly unsatisfying floating is not an accident. It is not a personal failure. It is not a side effect of the economy. It is not bad luck or poor discipline or a lack of financial education. It is a condition, and conditions, by definition, are created. The question worth sitting with is not, why am I not doing better? The question is, who benefits from things staying exactly the way they are? Watch a person on a Monday morning. They wake up before they want to. Their phone alarm, the same one they have used for 3 years, pulls them out of a sleep that was not quite long enough. They get dressed. They make coffee or they stop somewhere on the way, a detail that costs perhaps $5, a detail they have stopped thinking about because thinking about it felt like a kind of punishment, and they decided some time ago that small pleasures are not the problem. They are right, by the way, small pleasures are not the problem. But we will come back to that. They commute, they work, they eat lunch, usually something convenient, something that costs more than it would at home, but less than it would if they thought of it as a restaurant meal, a mental accounting trick they perform without realizing it. They come home, they open an app, maybe to check the news, maybe to scroll without a specific destination, maybe to watch something they won't remember clearly by the weekend. Somewhere in that evening, they check their bank account, not because they need to, not because they're expecting something, but because there is a low-grade hum of financial awareness that runs beneath the surface of almost every day. And checking the balance is the way they quiet it temporarily. The number is there. The number is what it is. They close the app. They go to sleep. They wake up on Tuesday and do most of the same things in a slightly different order. Now watch a different person, a few years older, a higher salary, a nicer apartment. They wake up the same way, maybe not to an alarm, maybe to light from a window they paid more to have face east. They make coffee at home now, a machine they bought during a period when they decided to stop spending money on small things. They commute differently, or they do not commute at all, or they commute to an office that feels more like the future than the one they used to go to. They earn more, they spend more. The categories have shifted. The subscriptions are more expensive. The vacations are slightly longer. The restaurants are in a different tier. At the end of the month, they save roughly the same percentage of their income that they saved when they earned half as much. They check their balance too. The hum is still there. It's a little quieter now. Quieter the way a noise becomes quieter when you have lived with it long enough. Not actually reduced, just accepted. Here's what both of these people have in common. They are both participating in a system they can describe in general terms, but have never examined in specific ones. They know what a savings account is, they know what interest rates are, They know what credit scores are in the way that you know what blood pressure is, as a number with consequences, not as a mechanism you understand. They have both at various points felt that something about their financial life was slightly off, not broken, not catastrophic, just slightly misaligned. And they have both at various points responded to that feeling the way most people respond to it, by working harder, by spending a little less, by downloading a budgeting app they used for 11 days, by telling themselves that next year, when things settle down, they will figure it out properly. Next year keeps arriving. Things do not settle down. The system, meanwhile, continues running exactly the way it was designed to run. Here's the thing about comfort. Comfort is not neutral. When you think of comfort as a financial state, as not being in crisis, as having enough, as not losing sleep over money, you are thinking of it as an absence of pain. But comfort in the context of banking is also a product. It is a designed experience. It is something that is built, maintained, and sold to you, not necessarily with bad intentions, but with very specific purposes. Consider what happens when you get paid. There is a moment, usually somewhere between seeing the deposit notification and doing the first thing you spend it on. A moment where the account balance is at its peak for the cycle. That moment produces something neurologically real, a small lift, a quiet sense of capability, a feeling that things are, briefly, okay. Banks know about that moment. They have studied it.
They have designed entire product categories around extending it, not so that you hold on to the money longer, but so that you associate the feeling with them. The debit card with the rewards program that gives you points when you spend, that is not a savings tool. That is a mechanism for making spending feel like accumulation. The financial wellness features in your banking app, the spending graphs, the category breakdowns, the gentle nudges, those are not there to make you financially independent. They are there to make you feel seen and understood by your bank so that your relationship with your bank feels like a relationship. The credit card that calls itself a lifestyle card, that positions itself not as a debt instrument but as a symbol of belonging to a particular tier of experience. That is not selling you credit, that is selling you an identity. And identities, once adopted, are extraordinarily difficult to audit. Now, here is the reversal. The behavior is you use a credit card responsibly, pay it off every month, collect the points, and feel good about the system. The need behind the behavior is the feeling of being competent, of being someone who has figured it out, of participating in something that rewards you. The way the system uses that need is it keeps you engaged with a credit product, it keeps your spending slightly elevated to maximize points, and it generates interchange fees from every transaction you make, fees paid by the merchants, invisible to you, totaling hundreds of billions of dollars per year globally. You are not being exploited. You are not being tricked in a crude way. You are being offered a transaction that is genuinely convenient, and the price of that transaction is a behavioral pattern that in aggregate serves the institution far more than it serves you. That is not a conspiracy. It is a business model, and it is one that works precisely because it is comfortable. The banking system does not operate on malice. It operates on mechanics. And one of the most important mechanics to understand is this. Banks do not make money from people who are financially free. Banks make money from people who are financially engaged, which means people who are borrowing, spending, moving money through products, and returning to the system regularly. A customer who saves diligently, invests independently, carries no debt, and uses a basic checking account is, from a revenue perspective, nearly invisible. A customer who carries a credit card balance, has a car loan, a mortgage, a personal line of credit, and uses a premium banking product every day, that customer is the model. Not because the bank hates the first person, but because the system was built around the second one. This is why the concept of financial wellness as promoted by banks is worth examining carefully.
When a bank offers you a financial wellness program, an app, a tool, a consultation, the goal is not to help you need the bank less. The goal is to help you feel better about needing the bank in the ways you currently do, and to introduce you to new products that meet the needs you have not yet met through them. Wellness in this context does not mean independence. It means a comfortable, ongoing relationship. Think about how debt psychology actually functions. Most people who carry debt do not think of themselves as people who cannot manage money. They think of themselves as people who made reasonable decisions in difficult circumstances: a medical bill that came at a bad time, a period of underemployment, a car that needed replacing before they were ready. And most of those people are right. Their debt did not come from irresponsibility. It came from the gap between the life that was available to them and the money they had to pay for it. But here is what is rarely said clearly. The credit system is not designed to close that gap. It is designed to let you live across the gap, to give you access to things before you have the resources for them in exchange for a continuous, compounding relationship. The gap never closes, the relationship never ends, and the interest you pay on that relationship month after month, year after year, is, for many people, one of the largest financial transactions of their life. Larger than any single purchase, larger than most investments, paid in amounts small enough at intervals frequent enough that it rarely registers as a number. It registers as a monthly obligation. And monthly obligations are not scary. They are just the texture of adult financial life. That normalization is not accidental. The consumer credit industry spent decades and a measurable fraction of global GDP in marketing and lobbying, making debt feel like a feature of modern life, rather than a product being sold to you. It worked, not because people are naive, but because the offer was genuinely useful, genuinely responsive to real human needs, and the architecture of those needs was studied, mapped, and built into the product before you ever encountered it. There's a specific kind of moment that happens when you stop looking at your financial life as a series of personal decisions and start looking at it as a series of interactions with a designed system. The numbers do not change in that moment. The account balance is the same, the debt is the same, the income is the same, but the meaning of those numbers shifts. Because once you understand that your financial behavior was not formed in a vacuum, that it was shaped by architecture, by design, by the deliberate study of how people like you make decisions under conditions like yours, you stop experiencing your financial situation as a reflection of your character, and that is a significant shift. Consider the credit score. You probably know your score, or you know roughly where it falls. You probably feel something about that number, a quiet satisfaction if it's high, a low-grade discomfort if it's not where you want it. What you may not have examined is what the score is actually measuring. It's not measuring your financial health, it's measuring your relationship with debt. A person who has never borrowed money, has no credit cards, carries no loans, and has a savings account with a comfortable balance, that person may have a lower credit score than someone who is managing 6 forms of credit simultaneously. Because the score was not designed to measure financial stability. It was designed to measure credit worthiness, which means specifically your predictability as a borrower. The score is a tool for the system to assess how reliably you will continue participating in the system. That is not a criticism, it is just a description.
But when you understand it as a description, when you see that you have been optimizing a number that measures your usefulness to the credit industry rather than your own financial well-being, something changes in how you relate to it. Now, look at the idea of lifestyle inflation. You earn more, you spend more. The categories upgrade gradually. The apartment gets nicer. The clothes get a tier better. The restaurants shift. The vacations get slightly longer. None of the individual choices feel excessive. None of them feel like decisions that are making you poorer. Each one feels like a reasonable adjustment to a changed income level. But the aggregate effect is that the gap between your income and your savings rate never really changes, because every time the income rises, the spending rises to meet it. This is not weakness. It is not lack of discipline. It is a very well understood behavioral pattern, studied, mapped, and absolutely incorporated into the way financial products are marketed to you at each income tier. As your income rises, you do not exit the consumer targeting system, you graduate into a more expensive version of it. The products become more premium, the language becomes more aspirational, the emotional positioning shifts from affordable to you deserve this. But the mechanic is the same. Spend slightly more than is comfortable to save. Maintain a relationship with debt. Associate certain purchases with certain feelings. Come back regularly. Now look at financial anxiety from a different angle. Most people experience financial anxiety as a personal failing, as evidence that they are not doing something right, that they should have it figured out by now, that other people their age or income level are handling this better. The anxiety is real, the discomfort is real, but what is rarely acknowledged is that financial anxiety is also a market condition. An anxious person checks their balance more often. An anxious person is more responsive to financial product marketing. An anxious person is more likely to take on new credit to smooth over a period of uncertainty. An anxious person is more likely to stay with a familiar bank even when the terms are not competitive, because changing feels like one more difficult thing in a life that already feels difficult. Anxiety keeps people in place, and the system does very little to reduce it, not because the system is indifferent to your well-being, but because a certain amount of ambient financial unease is, from a behavioral economics perspective, an ideal condition for maintaining engagement. You do not have to call that predatory. You can just call it a designed environment, and ask yourself whether the environment was designed for your benefit or for your continued participation. None of this is an argument for rage. Rage toward a system is one of the least useful things you can carry because systems do not feel it, and carrying it costs you energy that belongs to you. This is also not an argument for withdrawal, for closing accounts, refusing credit, living outside the financial infrastructure entirely. That is not a serious option for most people, and it is not the point anyway. The point is something much quieter than that. It is the difference between moving through a designed environment unconsciously, responding to it the way you were designed to respond, and moving through it with some degree of awareness of what it is. Awareness does not immediately change your bank balance. It does not eliminate debt. It does not produce income. It does not resolve any of the specific, concrete financial pressures of a specific, concrete life, but it changes the quality of your relationship with those pressures. When you know that your financial anxiety was, in some degree, a condition created and maintained by a system that benefits from it, you can stop blaming yourself for feeling it. When you know that the credit score you've been optimizing measures your value to a lending industry rather than your actual financial health, you can hold it more lightly. When you understand that lifestyle inflation is not a personal moral failure, but a predictable behavioral response to deliberately designed environmental cues, you can notice it happening in real time instead of only noticing it in retrospect. None of this is freedom in the dramatic sense. It is something more durable than dramatic freedom. It is the ability to look at your financial life clearly, without the layer of shame and confusion that the system, whether intentionally or structurally, tends to generate. You still live inside the system. Everyone does. But there is a difference between living inside something and being entirely shaped by it, between participating in a designed environment and being unconscious of the design. That difference is not measured in account balances. It is measured in something quieter. The quality of the Tuesday afternoon when you check your balance and feel for the first time in a long time, not like someone who is failing at something, but like someone who understands the game they are playing. That is not victory, but it is not nothing either. It is the beginning of a different kind of relationship with money, one that is not built on anxiety, aspiration, or the low-grade hum of a system running quietly beneath everything you do. Just clarity. Cold, calm, usable clarity. And that belongs entirely to you. If something in this video landed somewhere it was supposed to land, I am glad. Not because I want you to feel unsettled, but because unsettlement, when it is honest, tends to be the beginning of something clearer. If you found this kind of thinking useful, the kind that slows down rather than speeds up, that observes rather than prescribes, there is more of it here. Subscribing is entirely optional, but if you are someone who wants to keep looking at the quiet mechanics of financial life with this kind of attention, then staying here makes sense. And if something in this video shifted something for you, something specific, something you recognize from your own life, I would genuinely like to read it in the comments. Not to validate it, not to give advice, just to know what you saw.